Welcome back to Small Caps. My name's Kerry Stevenson. Today, we're going to be talking uranium. That's right. You've heard me speak about it before. It's one of those ones that I actually think that you all need to sit up and start looking at. Now, today I've got Keith Bowes. He is the Managing Director of Lotus Resources. Lotus Resources, the ASX code is LOT. Keith is the Managing Director, has been for a short while, but he's got a very long history in the uranium industry. And as I've said to you all before, I've spoken to Rick Rule about uranium. He loves it. As a contrarian investor, he thinks that uranium is going to be here and should be on everyone's radar. And as I've said to people before, it is actually a beautiful, clean energy source. So I'm excited to have a chat with Keith to share the Lotus Resources story with you today and to find out more about their project in Malawi and what they're going to do to get that restarted. So Keith, great to see you.
Thanks very much, Kerry. It's great to be here.
Well, let's start because this is the first time you've been chatting to our audience. So Lotus Resources have got a project in Malawi. Let's just talk a little bit about that, just a brief overview, and then we'll dig down into the bigger picture.
Correct. So Lotus Resources acquired the Kayelekera mine from Paladin in March of last year. So Lotus Resources as an entity owns 65% of the Kayelekera mine. The other 20% is owned by a private entity called Kayelekera Resources, and the final 15% is owned by the government of Malawi. So they're a significant shareholder in the project as well. So we did the acquisition in March of last year. Paladin has or had at that point in time two projects, Langer Heinrich and Kayelekera, both of which were on care and maintenance. Langer Heinrich being their bigger asset of the two, and hence where most of their focus was paid. Kayelekera was maybe a little bit of an unloved cousin within the group, and there lay the opportunity for us to take that from Paladin's hands. And really, I mean, it's Lotus's only asset, so it's our primary focus in terms of the redevelopment of the Kayelekera project.
Tell us about how that project. Okay. Oh, I've got a lot of echo here. Tell us how the asset came about for you to acquire it. Obviously, Paladin didn't want it anymore. They were focused on their other project, but why did you choose it and how did you come across it?
Okay, so maybe just a little bit of a history about Kayelekera first. So it's a past producing asset. It operated between 2009 and 2014, produced about 11 million pounds of product during that period, and got put into care and maintenance in 2014. Effectively due to this slump in the uranium price at that point in time. Their cash costs were about equivalent to the spot price at that point in time, and they made an economic decision to put the plant into care and maintenance, and they've kept it on care and maintenance since that point in time. As I mentioned, they've got Langer Heinrich as well, which is a much bigger project sitting in Namibia. And I think if you want to have a look at the uranium market, if you believe everyone, and everyone at the moment is saying that they think that the uranium price is going to pop in the next 12 months or so, if Paladin were to restart their assets, it would be very, very difficult for them to restart two assets at the same time.
Right.
Therefore, they'd be more focused on the Langer Heinrich one, and the Kayelekera would probably lag behind that a little bit. When we approached Paladin, they were very, very happy to come to a deal or put a deal in place such that we could acquire the Kayelekera asset off them, because we could bring that online at the same time that they would effectively bring Langer Heinrich online. And they're still a significant shareholder in Kayelekera as well. So they still get value from Kayelekera restarting back up again.
That was going to be my question. What is in it for them? Are there any interest? So what does Paladin get from you restarting Kayelekera?
So they're still a 10% or 9% shareholder in Lotus Resources at the moment. So they are they're one of our most significant shareholders at the moment. They get value from that as well. Also, when they were looking after Kayelekera on care and maintenance, they had an annual care and maintenance cost of around $5 million US. We've effectively taken that cost off their balance sheet. We've managed to reduce those care and maintenance costs, but we've effectively been able to take that off their balance sheet as well, such that they can use that money for their Langer Heinrich project. They've also had a $10 million US surety bond that's associated with the environmental bond, and we're paying that back over a period of 3 years as well. So they're getting cash from the deal, and they've also got a capped royalty of $5 million on the asset as well when it restarts. So there's cash generation from them, as well as the ownership in the Kayelekera asset.
You say that you're paying that loan off. How are you doing that if the mine is on care and maintenance and the price of the uranium price is still in the late 20s? How's that going to work?
So from our equity raises, from our capital raises, part of that funding goes towards that payment. So there was an initial $4 million payment made on the closure of the deal. We paid $1 million earlier this year, in February of this year. There's another $2 million payment required in February next year. And then the final payment of $3 million is required in 2023. So all of that money at the moment is coming from the capital raises that we do.
Right, and you've got enough. You've got cash in the bank at the moment, 12.5 million in the bank, so that covers that well.
The 12.5 million is from the raise. We actually had $6 million already in the bank, so we're more like 17 to 18 million dollars at the bank at the moment. So we're pretty well funded.
Okay, now Keith, I've just got to bring this up very briefly. You've been in the managing director role for, as we speak today, 3 to 4 weeks. What was that all about? What happened to the previous managing director? And because you were the technical director beforehand, and I want to know, what's it like going from a technical director into the managing director, and what's your strategy going forward?
So to answer the first part of your question, one of the reasons why there has been a change in terms of the managing director's position is that our previous MD was located over in Toronto. He was a Toronto-based person, and when we initially started putting the board together, the expectation was there'd be an opportunity for the MD to travel across to Perth, spend time with the team over here because the rest of the team is actually Perth-based, travel to site and meet the guys on site and all that. Unfortunately, due to COVID, that hasn't happened.
Yeah.
And the way we're looking at COVID at the moment, it's unlikely to happen this year either. So from that perspective, it became a little more difficult to be able to manage the whole process. And by centralizing the team in Perth, we think we have a more efficient system at the moment. I suppose on the other side of it as well, my background is an engineer. I was involved in Lotus Resources. I've been involved in a number of care and maintenance assets that we've looked to bring back into operation. And this is quite a sweet spot for me in terms of the technical studies, in terms of bringing an asset back into production as well. So I'm well suited to the role where we see the company at the moment.
So bringing something back into care from care and maintenance, is that a challenge? What are some of the challenges, or is it pretty straightforward?
I think there are challenges associated with it. Obviously, you've got a plant that exists, that was operating for a period of time and then has been put on care and maintenance for 7 years. There's a lot of work that's required in terms of inspecting the plant, making sure that there's no issues with the restart strategies or with the restart plans or anything like that. Refurbishment work is required, maybe some replacement of some key pieces of equipment. So those are the things you focus on rather than design types of things you might do if you were doing a greenfield project.
Makes sense. Now, you did a scoping study last October. What sort of things did that bring up? And were you able from that to look at how you could make it a little bit more efficient?
That was exactly the basis of our scoping study. So when we did the due diligence on the project back at the end of 2019, early 2020, we obviously did a detailed review of all the historical operating data in terms of how the plant was being run and being managed and that type of thing. And we identified 3 or 4 areas where we think there was a potential for improvement. So what we did in our scoping study that we announced last year was we set what we would call the base case for the project. So it's effectively a scenario that is very similar to the way the plant was operated previously. We understand what the capital costs are required to restart it. So that's the $50 million that we speak about in our scoping study. We also understand what the operating costs are associated with the plant. And an important point is to note is that the operating costs that we talk about are based on real data. We've gone back and we've looked at the historical operation in terms of availability of equipment, reagent consumptions, number of manpower required in order to operate the plant. So they're real numbers that we've got in the scoping study from an operating perspective. And then what we've done is we've identified, as I said, these 3 or 4 areas that we think have some real advantage for us. The first one is quite simple, and it's to do with power. So at the moment, the plant is operated off diesel gensets. Okay. So we know a diesel genset costs about 28 to 32 US cents per kilowatt hour to run. There is an opportunity for us to connect to the national grid. So we've been in discussions with Eskom, which is the Malawian utility. There is definitely power available on the grid. and there is a connection point available for us at the nearest town called Karonga. That's about 30 kilometers away, so we would have to install a transmission line and all that. But the cost of power in Malawi is significantly lower than the diesel gensets, less than 10 cents per kilowatt hour. So there's a significant advantage to us connecting to the grid. We're having a look at that. We're having a look at solar power. We're having a look at batteries. We're having a look at retrofitting a steam turbine onto our acid plant, because we have an acid plant on site to recover power as well. And initial calculations from that show we could generate as much as 2 megawatts of power off the acid plant, which is about 25% of our total demand.
Oh, wow.
So 25% of our energy demand could come for $0. So that's really quite significant for us in terms of moving forward. At the same time, we've identified some technologies that are interesting for us. There's a technology out there called ore sorting, which has been spoken about a fair amount, has been used in the gold industry and in the base metal industry specifically, but we're having a look at it from the uranium space as well. So Paladin had done some preliminary work on ore sorting on the Kayelekera ore and showed at a proof of concept level that the Kayelekera ore is actually applicable to ore sorting. So we've collected some samples and I'm going to be starting our own test work on that to do two things. First of all, can we upgrade our low-grade material? So we have a number of stockpiles on surface that run at about 400 ppm U3O8. Can we put that material through an ore sorter, reject the waste material, ensure we still get a high uranium recovery, but maybe end up with something that's 700 or 800 ppm of uranium that we can feed into the plant? That material then becomes very, very similar to our high-grade ore, and we would see some significant benefits to the project from that. So that's one of the main things we want to do with ore sorting. But there's a second interesting part as well, is that because the ore sorting technology has advanced so much these days, we believe we can use it to identify the high acid-consuming gangue minerals that are associated with our feed material. So if we could reject some of those minerals, some of those rocks that contain this high acid-consuming gangue, we could reduce our acid consumption feeding into our plant, and acid consumption is one of the key costs for the process as well.
Okay.
That's also an interesting part for us. There's some other things we're looking at that are perhaps slightly smaller in scale, but multiples of them in terms of looking at the resin plant, looking at acid recoveries, those types of things that will allow us to reduce the costs as well on an incremental basis. And then the last thing we want to have a look at is the tailings dam. So there's existing tailings dam there, but if you look at the schedule going forward, there's a requirement in about year 5 of production or so to build a new tailings dam, which is relatively expensive. Are there some other options that we can have a look at? We know that we deplete the existing mine in year 5 or year 6. Can we put tailings into the old pit instead of building a new tailings dam? These are the types of things we're trying to understand as well. And we would see that as a reduction in our all-in sustaining costs. So lots of exciting things to do over the next couple of months, with the idea that all of that work will then be consolidated into a feasibility study.
I'll get on to the feasibility study in a minute, Keith. One of the things I'd like to know is that as an investor, there's a number of companies out there that have got projects. Some are on care and maintenance, some are exploration, some are in production, and some have stopped completely and have moved on. What do you feel, because you've got a lot of background in this sector and a lot of understanding of this sector, what drew you to Lotus Resources and the projects, the Kayelekera project, most? You know, and I'm looking at this, I'm sitting talking to you going, okay, as an investor, what's the case for putting our hard-earned cash into Lotus Resources? Being really blunt there, Keith.
I think there's a couple of really interesting things that attracted myself and attracted Lotus to Kayelekera. First of all, it is a proven producer, and I think this is quite important when you look at talking to the utilities. As we have said, Kayelekera produced about 11 million pounds of product of U3O, of yellow cake, when it was up and running. All 11 million pounds was accepted by the various conversion facilities in the US, in Canada, and in France as well. So it's a well-known product.
Is that important, the acceptance of, I wasn't aware of that. So can you explain that a little bit?
So, I mean, if a conversion facility has previously treated a product that comes from a mine site, they have a lot more level of confidence there's going to be no issues with them incorporating it into their flow sheet. Because one of the things they do is they don't batch treat when they put it into their, for example, their conversion facility, you might get Kayelekera yellow cake mixed with other yellow cakes as well, all at the same time. And if there's something wrong with your yellow cake, whatever that may be, it may end up messing up the entire process for them. So they want to have a level of confidence they're not going to mess up their process by including your feed material into their plant.
That makes a lot of sense. So because it is produced before, it's going to be relatively easy to restart. You mentioned before, I believe, 50 million to restart it.
Correct.
Is that going to be a case of debt, equity? What are you looking at with that sort of money?
Yeah, so what we'd want to do for the $50 million that we need to raise, and just to be clear, the $50 million is for the refurbishment of the existing plant. If we implement things like the ore sorting, that's probably going to be additional capital required for that. Yeah. But we're talking tens of millions of dollars. We're not talking hundreds of millions of dollars to be able to restart the asset. We will always look for the optimum mix of capital, but I would see it being a combination of debt, being a combination of equity, and potentially even some forward payments with perhaps some of the utilities. They may pay us up front some of the product that we would produce, and we'd see that as a way of actually getting capital into the company for the restart.
And there is capital out there. I keep saying to people, there's, with the government's printing the funny money, there's plenty of capital out there for good projects. It sounds like this is a good project.
Correct. I mean, as you mentioned, we raised $12.5 million a few weeks ago. We were oversubscribed substantially to that raise. We could have doubled or tripled the amounts of money if we'd wanted to, but we were happy with the $12.5 million. If you look at the $12.5 million plus the money we've got in the bank, we're probably well funded up until the end of next year. And there's a number of options that are in the money at the moment. There's probably about 80 million options at 4 cents, between 4 and 8 cents. So assuming that our price stays where it is, you would expect some of those options to be exercised in the next 12 months or so. Additional money for us probably pushes over into 2023 without having to look for another capital raise.
Well, that's very encouraging for shareholders. And yes, your share price today, I think I looked at, it was about 14 cents. It's had a very good, strong trajectory. It's not gone up exponentially, but it's nice, a steady run up, which is good to see.
Yes.
This is just completely away from what we're talking about, but why is it called yellow cake? I've never understood. What's the background to the word? You mentioned it just a moment ago, yellow cake.
So the first product that was produced is a uranyl peroxide, which is actually yellow in color. And they produce it from a filter. So normally the stuff that comes off a filter is called filter cake. Oh. So yellow cake would be the combination of those terms.
Just had to ask him, ladies and gentlemen, because if I'm thinking it, I bet you guys are thinking it as well. Okay, so we're under control. So what is it that you're now doing? Because you're going to do a feasibility study in the middle of this year. So take us through the strategy going forward from now.
So as I mentioned, we've got these areas that we want to investigate, the ore sorting, the power, these other optimization studies. So we're very focused on getting that piece of work done now. So what we want to do, we want to complete that piece of work so we understand what the strategy for the company will look like moving forward. Once we understand the results from those various pieces of work, we would then take the results from those pieces of work and include them into the feasibility study, which, as you said, will start in the middle of this year. We would expect that feasibility study to take about 9 months to complete. So that's what we want to do from a technical side. We also, when we purchased the asset, not only did we purchase the Kayelekera mine and its associated mining license, but there's also 5 exploration licenses associated with it as well. 3 of them are contiguous with the mining license and 2 of them are further to the south. There's some really interesting anomalies, radiometric anomalies, both on the ones to the south and also the near mine ones there. So we want to undertake some exploration work as well. And we will initially focus on the targets that are close to the mine, such that they would be within trucking distance of the plant. That's what we want to look at first. But the other areas that we want to have a look at, perhaps in a more holistic view in terms of potentially doing some groundwork there, some ground magnetics or something like that, to understand whether there's a future opportunity for us to grow the resource there. Because our scoping study at the moment is telling us we have something between an 8 and a 14-year life of mine, depending on whether you just target the high-grade material or whether you incorporate the lower grade material as well. If we could find an extra, 7 to 10 million pounds of uranium, that would push us to a 20-year life of mine, which I think would be a very, very attractive investment case.
We've only got a couple of minutes left here, Keith. What I want to do is a quick touch on Manpower in Malawi, and Malawi as a jurisdiction. You mentioned that the government does have some ownership of the project. Are they supportive? They clearly are. And is Manpower easy for you to get over there?
So, I mean, obviously, as it was an operating asset, so they had a full Manpower there operating the plant. There was obviously retrenchments after the shutdown of the plant. But as part of the retrenchment process, there's a first offer deal, I suppose. The previous operators will be offered jobs back first. So we do have a pool of skilled workforce that we can tap into. Obviously, they haven't done things for a while, but certainly the skill set would be there that we could bring in. There is a large component of expats that would be required, at least in the initial years, for the training and upskilling of all the people. But we don't see that as being a significant issue. And it's important to note as well that of that $50 million that we talk about for the restart, that's not only capital expenditure in terms of refurbishment activities, there's also a large portion of that is put forward for training individuals, for recruitment and all that type of stuff. So the way we want to approach it is we want to probably have recruitment officers in all the major cities and within Malawi, so in Lilongwe, in Blantyre, in Mzuzu, and in Karonga, which are the four main cities, for us to be able to invite people to come and apply for the jobs, maybe do the initial evaluations there, an initial bit of upskilling and training there, then go to a dedicated training facility that may not be on site to get trained up and then arrive on site. So we've put quite a bit of thought into this based on Paladin's plans in terms of understanding how we want to tackle the manpower and labour issues when we restart back up again.
Speaking of restarting, when are you looking at for that, do you think, Keith?
Depending on the uranium price, I think.
Well,
I think we would be in a position after the completion of the feasibility study in early next year to make the decision to mine, assuming that the uranium price was at the right in the right area.
That pesky uranium price today is sitting at about 27.5, 28. What number does it have to be? Is it a 3, a 4, a 5, or a 10?
I suppose there is I mean, everyone talks about the spot price. So we're seeing the spot price at the moment of $27.5 per pound. The question is, what are the contracts being signed at? Yeah. And that's a bit of a mystery at the moment. I mean, it's not open information. We expect a contract to be signed at probably 20% above the spot price, seems to be the sort of norm for it. So you're probably seeing contracts being signed around the $35 per pound at the moment. That's too low for us. We would want to see, I would say, at least a 5 in front of that in terms of a term contract, and hopefully a 6 in front of it.
And there's a lot of talk about the supply being constrained, and there will be a pop in the price. Do you see that as well, Keith?
Yes, I think there's been a lot of discussion over the last few years about this gap in the supply and demand, and everybody's recognized it. The question has always been, when is that actually going to be filtered through to the utilities, and the utilities jump in and start buying yellow cake? Talking to a lot of people over the last few weeks, it seems to be a general consensus that maybe towards the end of this year or early next year, maybe the timing for that. So that's what we're holding out for.
Any last comments to our investor audience today about Lotus Resources? Because it seems to me like it's all ready to go. Just got to get that little price to pop up, and then you can get that feasibility study and you're on your way. Any last comments about those people that are looking at Lotus Resources as a potential investment?
Yeah, I think there's going to be lots of really good announcements coming out over the next couple of weeks, or next couple of months, sorry. We've got exploration work we're looking at. We've got our technology work we're trying to do around ore sorting. We've got test work starting on that. I think there's going to be some really interesting work coming out of that. I think those will be the main things. So, look at our website, keep your ears open. We've got some really good stuff coming out, which will hopefully result in a feasibility study that's significantly better than what we showed in our scoping study.
Well, that's going to be very exciting, that feasibility study later this year. Keith Bowles from Lotus Resources, thanks for talking to small caps today. And I'm going to look forward to having a chat with you later in the year. Maybe we can talk about that feasibility study, and that uranium price will be more in the 50s rather than the 30s.
That'll be great. Thanks very much, Kerry.